So the first of the core ATS components I'm going to cover in more depth is actually two of them. We're going to be covering our contraction boxes, which are right here, and also our expansion lines. Starting with contraction boxes, you'll notice that there's 4 different types of contraction boxes. We have our gray boxes, we have our red boxes, we'll look over on this chart here, we have green boxes, and then we also have green boxes with outlines around them. Now each one of those boxes, the different colors, the one with the outline, they all have slightly different meanings and they have a progression that they follow, which we'll get into in a minute. But we're going to be going through all those in detail. But also what comes with those boxes, not all of them, but some of them, we get our expansion lines right here. The expansion lines are representative of the center of the boxes. You can see that we have a little center line in between all the boxes. Certain boxes get expansion lines and certain ones don't. So we're going to talk about that in a moment. But let's first talk just for a second about what contraction boxes really mean. Contraction boxes are basically establishing fair market value in the market. Now, you might be asking, what is fair market value? Fair market value is when buyers and sellers become balanced in the market. They create a balancing. That means there's just about as many buyers as there is sellers in the market, and everything kind of stops and goes sideways just for a moment. It never lasts. Believe me, it never lasts. But for a moment, we have that balance that's created. Now, what's significant about this is, number one, it's establishing that point of contraction, that tightening in the market. But what's really significant about this is the price that it leaves behind once it leaves the contraction. That's our expansion line down here. Now, these lines, as the market goes, become very significant management points, as you can see through here. You can see where the market comes back to these lines and then it gravitates towards them and then deviates away over and over and over again. They are very significant. Now, the reason for that is because when buying and selling pressure becomes balanced in the market, what's also happening is that the market makers and the banks, their books of business from facilitating all the trading, especially on the market making level, is also becoming balanced and weighted certain ways. Now, what happens with this? Well, the banks and the market makers make all the money. They're the ones that clean up, and there's not very many retail traders left behind after they get through cleaning everyone out. So what ends up happening is that after they go through that contraction, they go into what we call expansion. And if they need to empty their book of business of the positions that they don't want anymore, they do that through the expansion phase. This is where they flush everyone out that they don't want to have the opposite side of their trade, and they get more of the kind of inventory that they really want. So that's all. We're going to get more into that later. But that is what's happening here as we break out of these boxes. So talking about the boxes more is that the boxes also show us where volatility is coming into the market. You can see this simply when we break out of a box. You can see that there's a few days that come down here and then we get a big move away from this level. As part of the 3 market phases, we're expecting a contraction, we're expecting some sort of expansion activity on full cycles, and then we're expecting a trend. So when we define true market value, we know eventually, we don't know exactly how long it's going to take, but we know eventually we will not be at this defined price anymore. We will gravitate away from it and form a new contraction box and start the 3 market phases over. So you know when you have that defined level, you know exactly where you're going to move away from, and you could manage accordingly. So let's go through the progression of boxes. So boxes always start as gray right here. These are our gray boxes. We call these minor framework boxes. Now, minor framework boxes, you could think of these as almost kind of like a warning that you're going to go into a full market cycle. They don't all go into full market cycles, but this is what could potentially turn into one. So it's kind of a warning, so get prepared. They're either going to have massive volatility leading away from them, or they're going to start a full market cycle, having multiple expansion legs and going into a full trend cycle. So let's talk about that. What happens when a box turns from gray? They all start gray, remember. The next progression is them turning red. Now, what makes a red box is, well, let me see. Can you see the difference? Can you see the difference between this box or even this box and this box? Well, let me tell you what happens. This box right here broke out, the price traveled down, and then it formed a new box. You could clearly see that. This box algorithmically broke the tracking of the previous box. That's how the algorithm works. What happened on this box that's different is that we broke the bottom of the box and then came back and broke the top of the box. Now that whipping action, that breaking out low and breaking out high, and this could also be reversed. It could go high or low. That 1 and 2 leg expansion activity is what makes the expansion point or the contraction point more significant. Because now what we know is that the market makers have not only taken prices down, but they've also taken them up through that point. And by them expanding around this point more, they're making this more and more of a significant point. So we're not going to draw an expansion line until we actually get the first expansion leg down and a corresponding one up through. And like I said, it could also be up and down as well, vice versa. But that makes us, from an algorithmic standpoint, want to define that level more as opposed to defining this level down here, because it did not have that 1 and 2 leg expansion action. So that's what creates a red box and starts painting forth an expansion line. Now we're going to move on to the green boxes. Once a box turns red, you can see right here, it has that first expansion leg, then it has that second expansion leg. That creates a red box. What creates a green box? Well, a green box has 3 expansion legs. So you have the first expansion leg breaking out right here. The second one breaks down through the bottom of the box, through that liquidity line right there. At this very moment, that's where we got the expansion line. That's where we know it turned red. But how do we know when it turned green? Well, the box turns green when we get a third expansion leg. That happened right when we came through that liquidity line right there. On that very moment, this box turned green. And basically all this means is that now that we have 3 expansion legs that are dancing around that singular contraction point, it means that the market makers and the banks have deemed this a more significant area that they're going to move from later on. Typically, the more expansion legs that you get, and you could go on to have 5, 6, I've seen as many as 9 and 10 expansion legs on from one box. But the moment you get more and more expansion leg activity associated with a box, the more you know that when the market finally breaks from that level, it's going to be a much bigger, significant move. So it's showing you a progression. Now, our last box is going to be our green box with the red outline. These mean the same thing as the red and green boxes, but the only difference is that the first 2 expansion legs happen within what we call a trapped range. It's referencing the last high right here and the last low, and the first 2 legs happen within the boundaries of those. This just shows a little bit more significant tightening of price, and that there's not a whole lot of commitment on the higher time frames and the bigger bank levels just yet. So this could signify that you're going to be doing many more expansion legs around this point, and that this point could last a lot longer than other points. So it's just showing us that progression. Now, all these different types of boxes, they don't need to be overcomplicated. What you need to know is that when you break out of a box, you're going to have volatility coming into the market. You're potentially going to have a pretty big move happening, so you want to get ready for that. Also, when you break out of a box and form an expansion line, that line is going to act as your center of gravity. The market could deviate away, it could come back, and ultimately, when the market finally trends and goes up to higher or lower prices, that will be the level that it will trend from. So another thing that we want to talk about with the expansion lines, if we look at this activity right here on our higher time frame, if we look at the daily chart right here, we can see that the market moved down about 11 days in a row. And we know that it's just kind of gravitating right, you can see right back to value. That's how important these lines are, because we could project where price is likely to reach to, even when it's coming back. Now, if we knew that the market is moving down, we knew that about right here when the market confirmed it was going down and the candle closed yellow. So we could have projected that we could have had a move down here. It's not guaranteed to happen, but it's a possibility. The fact that we know the higher time frames are moving down, what does that say about prices over on our lower time frame? We know there's 48 candles, 48 30-minute candles inside of one daily candle. If we know the direction of the overall day, then we know that most of all the contractions leading into expansion are going to end up with the trend phase going down with the daily chart. So let me show you here. As the market rotates over here, you can see our first contraction point right here. We have an expansion. We have our first leg, our second leg, third leg, fourth leg, fifth leg. See how it just keeps expanding out right around this point, comes down and then holds that point. That's why you want to look at those in the future, and then leads into a big trending move down to lower prices. That is the three-phase cycle right there. You have your expansion, you have your expansion legs right there. You have your contraction, you have your multi-leg expansion, then it finally settles, and then it goes in the predicted direction because this was already going down. Now, as we go down through here, you have the the contraction, same thing. Here's the expansion. But at this moment, because this is already going down, we have a predetermined expectation that it doesn't have to happen, but there's a high probability that on the trend phase, this is going to go down and establish a contraction at lower prices, just like it did here. Same thing with this one, same thing with within this one right here. This was a big expansion, but you could see so on and so forth that we have that predetermined expectation. Now going back to the boxes and the value lines, the expansion lines, if we know where this direction is likely headed, then this becomes a very significant point to manage our trades. We know that if the market is declining in value, we want to sell the market when it's overvalued. We know that we're getting a better deal. Whereas if we sell the market below value, we have the chance of it pulling back to value. This is all part of the basic strategy of using ATS. So these lines become very significant as we go forward, and they're going to become very significant management points as you trade. You can see right here, as we pull above, we have the candles reach above, it goes down, and then it holds that line again, and then keeps on moving down. So there's so many different ways to use these lines and be creative with them, but that's the most basic way, is understanding the fair market value, understanding what happens when price leaves value, and then understanding how to use and look at that price across different time frames as the market comes back and revisits it in the future. And you'll know that eventually, on all of those value lines and contraction boxes, that eventually you're going to go into that third trend phase, and the market's going to move significantly away, and that's the phase that you really want to be interested in when you're trading.